that level specifically tonight, and we're going to go over a couple approaches on how I look at higher time frame support and resistance levels, and how you can use that to do some pretty significant trading and waiting for key levels to happen on your lower time frame. Let's give Ali Shijo a minute or two. He just signed on. Make sure he gets his audio. I appreciate your patience, folks. If you have a question, or if I need to go over something again, if I was going too fast, or if I didn't adequately explain a topic or a point, just more or less say, you know, can you do that again, or can you go into greater detail? Other than that, can you keep the chat on the chat box quiet? Because I'm really looking to that for you to get my attention. That'll help everything move along, hopefully seamlessly. And at the end, when we close, I'll hang around for about 15-20 minutes. You got any questions? I'm not constantly talking, so if you're hearing intermittent, it's because I'm only speaking and then stopping.
Mommy say. All right.
All right.
All right, this is the daily chart on the cable British Pound USD pair, and we're going to be highlighting this 157.30 level. Well, you need speakers, not a microphone. All right, 157.30 level. Right here. This is the level that we were monitoring for weeks now on the cable. And again, this is very similar to what you've been watching on the YouTube channel. If you go back over the chart, we're going to more or less follow this line.
Come on, Johnny, don't do that.
Right in here.
No.
This
Yeah,
low
goodbye.
in September of 09. You're not getting any audio? Okay. Yeah, I apologize, guys. It's... No, you cannot have control, Aaron. All right. And now what we'll do is I'm just going to open up a plain, brand new cable chart. And throw this on a weekly basis. Okay. If you look at the weekly chart of the cable, this red line is 157.30. Okay, and I know it looks like it always, for whatever reason, I can't understand why it does it, but I just set it to go right to 157.30, and it always moves a little bit and shows, like this case, it's 157.26. I don't know how I can fix that, but it is what it is. But what I want to draw your attention to is if you look at the lows back here. Now this low happens to be in 09, and you can see how we had this week's high, ran right into it, almost went down to it here. Nice railroad tracks in here. The high in here, the low in here, the high of this candle, the body of this candle, the low of this candle, the low of this candle, and the high of this candle. Okay, so hopefully you guys can see this is a very clear level. And one of the exercises I did as a new trader years and years and years ago was I actually took an overhead projector, clear, you probably remember these in school, a very clear piece of plastic, and I took a Sharpie pen and drew a horizontal line with a ruler on it, and I would take this and lay it across. At that time, I used paper charts, and the first, I guess it was 3 or 4 years of my trading with futures and commodities, I was trading the grains and agricultural markets, and I would take this overhead projector, slide, okay, transparency sheet. It was just a piece of plastic, really, with a horizontal black line drawn across it, and I would lay that directly over top my chart, my paper charts. And the charts I used were from PriceCharts.com, and that's usually where you guys see my Commitment to Traders weekly charts when I share them. It's not often that I do it, but that's what I've used since the early 90s. Well, I would take this clear piece of plastic and I would more or less do what I'm about to show you here. I'd start at the highest high on whatever time frame I was looking at, okay? And I would just slowly, incrementally move it down across the chart, okay? And wherever I saw levels where the price very clearly have a difficulty getting above or cluster around it, okay, those levels I would draw attention to, and I would draw a very light pencil line across the chart. I wouldn't do anything in pen, okay, just a very light pencil mark across it. Now if you take the line and you pull it across, I mean, you start seeing levels, okay, like for instance here. Hopefully you guys can see how we had the low here, the body's candle high here, the body's candle low, the high of this candle, the low of this candle, the high of this candle, the high of this candle, the bodies of these candles, the body of this candle, the body of this candle. You can see there's a whole lot of clustering around this particular price level. This level was 163.86. Okay, that right there would be an institutional level that I would have noted on my chart. Now, back, obviously, this is hindsight back here, but this is the same principle that you use when you use your real-time trading. And if you look at, do this as an exercise, go back over March of 2011 to August of 2011 and see if that level gave you anything on the lower time frames and around the 163.80 institutional level in the cable. And you'll see all kinds of opportunities, I'm sure, around that price level, okay? The most recent price action we have here, we're going to move from this area here. What I'm doing is I want your eyeballs over here, so just focus over here.
Stinks.
As I drop the horizontal line down, okay, hopefully you can see that level right there. that level right there is very handsome because you have this low, the bodies of the candles, this high, this high, this high, the body of the body of the candle's low here. And when I say body of the candle, I'm not talking about the wicks here, okay? This is the body of the candle right here, that part that we actually see that makes up the candle, okay? The actual close of the bar. Obviously, you can hopefully see this nice rejection. Okay, that's particular interest of higher time frame support resistance. We have the low here, the bodies of the candles in here, the high of that candle, the lows of the candles, high of this candle, the high of this candle, the low of this candle. Okay, so that level would end or should be noted on your charts. It's 157.67. Okay, so if you're looking at that, the 157.70 level or 157.60 level, okay, small number, okay, you would have that on your chart. Okay, moving on, as you drop your horizontal line across, and again, we're looking at a weekly chart of the British pound. Okay, and I'm making this a very long-winded explanation, and it's probably very obvious to you. Okay, but I'm just more or less going through what I do, because the questions are, how do I do, my key support resistance? How do I find them, and how do I note them, and why are they so effective? It's because this is what I'm looking for. I'm looking for levels that are very clear, very discernible levels where price has been moving to and fro, but gravitating away from a specific price level. And all I'm doing is rounding it to the nearest round number. Okay, if it's close to an institutional level, like a full figure, mid figure, or 20 or 80 level, that's great. But it can still be rounded to a 30 level, a 40 level, 60, 70, or a 90 level. Okay, we look for signals to generate around the round numbers, okay, because that's what institutional traders and bank traders are looking for. They're not doing their entries on small round numbers, okay. So again, moving lower, okay, here's a nice level as well. We have the body of this candle here, the close on that candle, the high of that candle, the low of this candle, the lows and the bodies of these candles here, the low of this candle, the high of this candle, bodies of these candles in here. Now, you want to answer your question, no, it's not being recorded. Sorry. You have my permission to record it if you do have that capability. Again, the high of this candle here. You have the lows of the candles here, the bodies of the candle. Can you guys clearly see the bodies of these two candles here I'm drawing the cursor to? Okay. See the bodies of these candles here as well? See how they're flush right on that level? Okay. I didn't move the line. Yes. Harry, go ahead. Go ahead, Harry. You have my attention. Mm, what was that? The body of the candle is the portion that we see on the candle. Okay, and it's the difference between the open and the close, yes. It's not necessarily the high, they're the wicks. Okay, so you're just looking at the bulk of the candle. Okay, so in other words, all you're doing is looking at the open and the close of the candles, yes. because you can see a lot of that overlapping. And whenever there's overlapping, that could be a convergence of a particular price level, as we have noted here. All right, we're going to look at, we're going to come back to the weekly chart in a minute, okay, but we're just going to look at this particular price level, okay, and I'm only stopping here because it just so happens that if you note the level is 156.70, so it's a round number, okay, very clean round number, and we're going to drill down to an hourly chart, okay. Now this is what's happened this week so far at that particular price level, 156.70, okay. Now I'm going to take the scroll off on here, and I'm going to scroll back and see if we had anything given to you at that particular price level. Does anybody notice anything here? It's a lot of clustering around that, yes. See anything there? What is this? What's occurring on there? Who's accumulating? Now, while they're in this range in here, okay, do you think that it is important for you to understand what's going to take place while we're trading like that and moving up 280 pips? Remember the cycles? Remember the cycles I did, good grief, 2 years ago, where we talk about how markets go from ranging, okay, to trending. Here's a trend, and then we go into another accumulation phase, okay, and the market rallies up again, goes into a consolidation again, and then trends. Consolidation is like a trading range where it's not moving in a clear discernible trend up or down. Let's go to a 4-hour chart. Maybe I can get a little bit cleaner price levels. All right, this one helped out a lot. All we're doing right now is we're just looking specifically at this particular price level we noted from the weekly chart, okay? And I'm going to go back to the weekly chart again, recap, and go back over what it is that we're doing from the weekly chart down. But you can see how this particular price level in here, this is a higher time frame key support resistance level, okay? Okay, consolidation. Can you see how price remained in a relatively small consolidated area in here? Okay, prior to any significant price move up or down, you're going to see this happen in any time frame, regardless of whatever chart you're looking at, whether it be a 1-minute chart, 5-minute, 15-minute, 1 hour, weekly, whatever it is. Markets will always move from a consolidation or range-bound environment. Then you'll have a move, a release. Price will be allowed to move. Okay, the dealers will allow the accumulation phase that took place here. Once we come out of this, we're going into the profit release portion. Okay, and once it moves a little bit, it gets everybody excited. They all start buying it. Now they may make money in here, okay, but again, because we just came out of a consolidation and we had a nice move out, price in this instance moved from, we're going to just use this key level as a median, it moved 240 points, or 240 pips rather, okay, and then moved into a new consolidation. Oops, I just moved the line. I didn't want to move that. So now we move into another consolidation. You can use the same idea with COT, because that's what's happening. The COT is going to give you, when price is in this range like this, okay, when price is in this range, you want to take a look at see what COT is doing. In other words, where's the commercials at on the trend? Okay, are they net long in here? And this happens to be March of 2012 this year. And if they're net long or rapidly reducing their short position, okay, that's the insight you look for, okay, and then price will run up, then go into another consolidation, and they'll allow more market participants to get in here, okay, and try to look for short signals, and they'll build this larger base, and they'll pair up orders, allowing bears to come in, and then once they get a nice base of longs established in here, they'll allow price to release and go higher again and come back into these other ranges as well, and then go and trade even higher. But my point is, and I don't want to stray too far away from the topic here, this is the consolidation. And the level we noted on the higher time frame was the 156.70 level. What in this area are you hopefully able to spot that we've been talking about for a long period of time? Exactly, optimal trade entry. Okay. Hopefully you guys saw this. Okay, here's your sweet spot. Okay, and you have a whole day, essentially a whole session to establish a long position in here. This particular candle on a 4-hour basis is the new day, 0 GMT. Here's 4 GMT. Here's London open. This happens to be the lowest of the candles. Here's New York open, and then the price runs up. Market flow is going to be of no help to you when you trade up against a higher time frame support and resistance level. Okay, key support and resistance in the higher time frame trumps it. Okay, and that's that's a good point. And before I leave this example, I'll kind of tie in market flow and market structure as well, because that was also a topic that was posted on a thread. Okay, well, accumulation can be accumulating short positions or it could be accumulating long positions. The accumulation phase is really just assuming insight on where the next market move is going to transpire. In other words, this was a consolidation. Okay, when you're new, you're going to be able to label the past and study the past to hopefully get a feeling for what you're going to be doing when you see these types of examples happen again. And here we can clearly see in hindsight, this was accumulation for long positions. Okay, smart money was accumulating long positions. Then we saw price break out and move higher. Went into another consolidation. This was another accumulation phase. Okay, and then there was a profit release portion of this larger price swing. Okay, and price moves up even higher. If you're just purely looking for market flow, okay, and let's put this on here using this one specific example. And again, I don't want to go too far with this because it's too easy for me to go down these rabbit trails and really never deliver what I've aimed for going over tonight. All right, you have all your little fractal highs and lows, okay? If you look at how, let me have a little trend line here first so that way I can keep track of where we're going. All right, what I'm going to do is I'm going to change the color to red on this one, and I'm going to change the color on this one to blue, and it's only going to really delineate when it's blue, it's bullish, in other words, the market flows up, and red will be when it's down. And obviously, market flow is always up or down. It's never neutral. Okay, it's always telling you to be in, up, or down. Okay. All right, let me see if I give you an illustration of how this works. All right, here's a good one. It would have to be on this one. I'm getting my colors mixed up here. Sorry, guys. All right, looking at this, we've identified a higher time frame key support and resistance level using the concept that we were just discussing on the weekly chart, which is basically taking a horizontal line, as we have here, and just drag it across your chart from all the way from the highest high and drag it down. And just note where there's really key levels where price seems to bounce off of multiple places. Okay, and I guess this is a one way that you can use. I don't use trend lines in the sense that, you know, a lot of people use trend lines. In other words, I don't like diagonal support and resistance. I just don't like it. I don't trust it. It breaks a whole lot more than horizontal support and resistance will. And that's just my feelings about it. I mean, you can use trend lines in your charts and love them to death, but I'm never going to be a subscriber to them unless we're talking about trading wolf waves. And wolf waves, then I use trend lines for that particular trading pattern. And I haven't talked about them yet, but if you want to know more about that, just go online, check out the Street Smart's trading book. It's kind of pricey. I paid $175 for it. I think you can get it for free, really, if you look hard enough for it. I'm not trying to, tell you guys to go out there and steal, but there's other avenues to get that book, and I'm sure there's people out there that will be willing to share it with you. But wolf waves are covered in that book, and you don't need to know anything more than what's already explained in there. I spent a lot of money chasing greater insights with wolf waves, and what they did in that book is all you need, really. But anyway, looking at that key support resistance level, okay, if you're looking at the fractals, okay, for market flow, this would be your most recent swing high. This is your most recent swing low. Okay, price breaks. Okay, it's just a little bit, but it breaks the fractal swing low right here, right on that candle here. Okay, so at this point, market flow by definition on the 4-hour is down. Yeah, the book is called Street Smarts. Larry Connors and Linda Rashad. I may be pronouncing her last name brutally wrong, but I try to avoid saying her last name because I just don't know how to pronounce it correctly. But if you need more insight or whatever, just hit me up on the thread, and I'll send you a link. You can look at it some more. No problem. All right, so looking at market flow, you have market flow switching from bullish, and as it did here, in other words, this fractal high, when we ran up here, that put market flow bullish. And you would be using this swing low here until this swing low formed. Okay? But when price came down, okay, and then bounced up here, this is the new higher swing low. That's why I didn't reference this swing low. It would be using this one. And it broke it here on this candle. So now market flow by definition is down. Now for it to change bullish, it has to trade up above this swing high or a lower swing high. Okay, that once this is formed, we just track these 2 points right now. Okay, so moving forward, we now have a lower swing low. Okay, market flow is down, so you just keep moving your reference points, and that's what you want to keep these little segments on your chart. And I mean, this is how I do it. You can find your own way of doing it if you don't like it this way. But market trades up, breaks a new, see this swing high here? When this swing high forms on this candle here is when you actually see the fractal form. It's broken on this candle here. So now market flow is bullish. Okay, so here, now here's the broken swing high. Okay, this is the swing low. Now until this swing low is broken to the downside or a higher swing low is broken, which we don't have, okay, market flow is now essentially bullish. This is what I'm trying to teach you guys with the higher time frame support and resistance levels. Do not try to always, just because I can show examples of it, don't go in there and try to zero in and try to catch the very low of the moves. You don't need that, okay? Market flow changed bullish here. Right on this fractal it formed, it was broken here on this candle on a 4-hour basis. You don't think you can make money in this? I'm certain you can make money in that. This is the move that you can capture intraday, trading the New York or London close if it gives you a trend following signal. Okay, but this down here, this higher time frame support level, this is what all of this really based the swing from. Okay, look at how price acted back here. Look how it traded back here. You don't think there's an interest in that level? Now we can fine tune it, and we're going to do that in a moment. Okay, but this just draws your attention to where the big money is going to be looking to establish a position. When you see this, okay, it's going to draw your attention to a specific area in the marketplace where there's going to be a large influx of institutional sponsorship behind the moves. And that's what you need as a trader when you want to capture these explosive moves that go on, and it's very forgiving in terms of your entry and your exit points. That's what you want. You can be very, very late, okay, capturing a move like this as long as you're trading in sync with the move itself, bullish, okay, you can get a lot of this. And this is a nice move. This is about 110, 130 point move just in one 4-hour basis. This is a 4-hour chart. So if you're looking at the higher time frame support and resistance levels, as we noted here, the 156.70 as this example, and this is obviously a hindsight example, but it's going to illustrate what it is that I do and how I break the market down and how I wait and I stalk a specific setup around these particular levels. Now, is 56.70 an institutional level? Not at institutional level, small round number, okay? 20s, 80s, full figures, mid figures. Okay, but you still can look for price action to start giving you uh, insights as to what it may do. Okay, so now watch what happens. If you look at price, okay, and this is what you do. This is what I call calibrating your key support and resistance levels. If you've identified the 156.70 level, now note we're going to go back to a weekly chart and I'm going to recap how this line across a large period of price action has been insightful, not just on the near term for this time of the year. It's, you probably hear the youngest one, sorry. Okay. Now when you have the level drawn to your drawing your attention to 156.70, where would you go to determine where the higher probability level would be? This is just drawing your attention to the higher time frame, but you calibrate with the lower time frame. So we found this level in the weekly chart. Now we're zooming down to a 4-hour chart. Looking at this chart here by itself should give you insight. How do you look to tighten this line up to a more specific or apt level? Okay, well, the real short answer is look to the left side of your chart. Okay, we have this price action, and we're assuming for a moment that we're looking at price here. Okay, we're looking at price here. Now, yes, this is a level we noted on the weekly chart. We found this level going through the practice that we're going to recap, in a few minutes. But going back over here, can you see this low? I mean, did that not have a nice reaction? I mean, what did price do when it went to this level? Rallied up big, didn't it? You think price had any kind of interest in buying here? You had optimal trade entry here as well. Now, this particular price level, okay, 70, is a little bit higher than all the lows in here. But watch what happens when we start drawing the levels down to specific lows that price had reacted to in the left side of your chart. Do you see what I just did? I allowed for sweeping, I call this, okay, where it goes just below, or it can happen above a particular price level. We have a low here, we have a low here, and we have a low here. It went to below it just a little bit, but it still reacted. Okay. Now this level is 156.48. Now how would we calibrate that to a specific price level that we like to watch? Exactly, 156 mid-fig. Okay. Now using that insight, let's go back to this example. Okay. And we're going to calibrate it to 50. Okay. So now we're going to blend a few things with this support resistance level. All right, we have this low here that went below, obviously, the level we were stalking. But look what happened. We had 4-hour change, a market flow on this break of this candle here. Market flow turned bullish. So now we're in a stalking mode for looking for long positions. But how do we do that? We have a stage set to be looking for buying opportunities on the cable, given this opportunity right here. What do? If we have a premise, which is in this case is to be a buyer, okay, because we're trading at key support resistance level on a higher time frame. Now we have a bullish market flow on the 4-hour. What do you have here? Is that not the price swing that you'd be measuring a retracement into? Exactly. Okay, so what we're doing is we're taking the higher time frame support resistance concept and we're applying it to price action. We're calibrating it to a more closely uh, user-friendly price level, because the higher time frame levels, they may be off as much as 15 pips. And it sounds crazy, but when you see this over and over and over again, that's why when I tell you when there's a confluence, the maximum I allow for variance, okay, when particular signals or patterns or tools converge at a particular level, I will allow as much as 15 pips. Now 15 pips may sound crazy to you all, but I'm going to find what I need to find inside of that 15 pip variance on a lower time frame. It won't be a guess. You know, you'll see exactly what I mean as I build on this example here. But that higher time frame level, now we calibrated. We just moved from 70 to 50. Okay, but we used real price action on the left side of our chart to warrant that. Okay. Now you take the low, and we're looking for buy, so you find the low, and this is the price swing that you hopefully can see. This is the dominant price swing or bounce. Okay, it moved up and gave us a bullish market flow. Once you take a fib and you pull it from the low up to that high, look where your optimal trade entry point lays. In this example, it's 156.44. How many pips away from the mid fig is that? It's only 6 pips, guys. 6 pips. So now watch what happens. Okay, price trades up, comes right down into optimal trade entry, and guess what? Look where the 79% retracement level lays. That's the low. Moving on out in time, everything becomes obvious for market flow traders, okay, here, when market flow breaks this swing high. If you're just always looking for breaks above and below and not having the higher time frame premise in mind, it's going to get you out of a lot of opportunities, because you'll be looking at all these whipsaws where, okay, market flow is bullish here, and then it gives you another swing low here, and it goes below it. Okay, well, uh-oh, I can't be a buyer now because market flow in the 4 hours bearish. Well, look what's happening. I told you this is going to occur. Higher time frame support and resistance levels trump market flow. You have to trust the levels more than the market flow. Now, when market flow switches, when it's in sync with something like this, like for instance, we have a higher time frame key support level, that by itself is a means to expect a bounce. Okay, in other words, bullish move. When market flow changes to bullish in that scenario, you have a whole lot more easier trading ahead of you. Now everything is, you start looking for your intraday scalps on the buys, and just look for, retracements, and looking for optimal trade entry. I love you too, son. The optimal trade entry to get you in sync with the higher time frame. So you guys get to hear everything I always edit out of the I can't hide from you. So we have the move underway here based on finding a higher time support resistance level, okay, and then market flow obviously turning bullish here. Now, every time the market makes a swing low, you just take that red line or whatever you use to delineate when market flow changes from bullish to bearish. I'm sorry, yeah, from bullish to bearish. In this case, you would have it here, okay, and I'm going to put the left side of that, noting where the most recent swing low is for this example. It would swing and break to bearish here, okay? But look what happens. It goes bullish again when it breaks this swing high here, okay? And then price breaks the swing low here, takes the market flow to bearish again. Okay, it breaks it here. But look what's happened. If you just look at market flow, in this case being bearish again, you miss the optimal trade entry that gives you the buy. Okay, you miss it. And that's the problem you get with market flow and not applying market structure. So now I'm going to tie this together, and give you an example of how they both blend. In this example it is. But you'll find it by many times using it with your other tools. It takes a lot of the guesswork out. Okay, and I'm hopefully communicating that. Now, I'm going to take the fractal stuff off because we don't need that here. We established the higher time frame 5670 level calibrated down to 5650, giving us this optimal trade entry. Now watch what happens. Okay, you're in a bull move here based on that higher time frame support level. You have to look at your price swings. Okay, if we're looking to go up based on support and resistance levels here, what price swings is price looking to fulfill on the other side? In other words, we have, hopefully you can see this high down to this low. Does anyone not see this price swing here? I mean, it's obvious. It should be very obvious to you. Okay, we have this high down to this low. If we're looking to go higher, at some point, price is going to at least trade back up to this high, as we have here. When it does that, when it breaks these highs on this candle, this swing high becomes what? It transforms into what? Exactly. What does that mean? Well, it means that you take the price swing that moved from that high down to the most significant low, which is here. Okay? That will give you a measurement to look for upside objectives. This is market structure. Okay? When you have market structure blended with market flow, blended with higher time frame support and resistance levels, you have a whole lot of excuse me guys, I didn't have my phone muted. Alright, we have market structure, which is basically using price swings. Okay, price swings to price swing. This high down to this low. If this high is broken, okay, it's acting just simply the same principle that market flow happens to have. Market flow, in this case, if we were using this as a swing high, when market flow breaks it here, okay, that puts you bullish, does it not? If we were thinking in terms of like market flow. Yeah, I calibrated everything. Basically, my fib tool is the 0 level, the 23.6 level, 38.2 level, the 50 level. I round to 62. I go to 70.5 for the sweet spot. 79%. This is the 90 level, and 100. And all these levels up here are the same levels, just in reverse. Okay, and I'm going to cover that too because we had a couple comments about Kubio, I guess it's Kubio. He gave an example of fib projections, and a rather snide remark was left on the thread, and a couple people gave it a high five, and I think he's given a good example of it, but I think a lot of folks get distracted by all these levels and they don't understand why I have it, because I haven't finished teaching you Fibonacci yet. There's a lot more things except for optimal trade entry, and it's a lot more than these projections. Okay, and I'll give you an example of that in a moment. Yes, 90 is where I would kill an OTE trade. I'm looking to either kill the trade and save the stop, or cut the trade in half and just keep one half of it on. But you'll learn all about that also in the trading plan stuff. All right, so let me finish this example because I really want to go back to that weekly chart again. All right, so we have this high here. Yeah, you haven't seen anything yet. So this high here down to this low, when it breaks this high as it does here, okay, we know that probability suggests that if this isn't bullish move, okay, we should see this pip range duplicated from this high up, okay? And that's what the 200 extension is. It's just a replication of the range from the 100 down to the 0. And that's what the 200 is, okay? I got tired of using the Fibonacci and then dragging the fib across where I would used to lay the 50 level here, and then the 100 level will be up here. You guys remember that from the old Pro Traders Club videos? I tried to just more or less, I tried to clean it up so you guys could have a little bit easier way of doing it. And I lost a lot of folks in that explanation. Why are you putting in the 50 level in there? It's just, this is a lot easier. 200 is just so much easier. So this is why it's the same principle that I used to do in the Pro Traders Club. And, you know, just have your Fibonacci tool, you know, set up like this, and you have the same, same thing I have. Now, I'm going to use this to segue into, again, we're using the high here, projection. The Fibonacci tool calls to 200. Now, is that accurate enough for you folks? I mean, you guys can see that, can you? Hang on one sec. Let me get the troops calmed down a little bit. Okay. All right, thanks for coming out, man. All right, audio check. Can you still hear me? Okay. All right, so we have market flow, okay, bullish in this area here on the 4-hour, and that puts you in sync going up, okay? When I say trade in the direction of the market flow on a 4-hour basis, that's what I mean. You want to trade when you're trading off a higher time frame support resistance levels. When the 4-hour changes and gets in sync with it, that's it. That's it. Now you're in sync with a buy program, okay? And then you just start looking for your optimal trade entries, your power 3 positions to enter, usually at the London Open. Let's throw that on here right now real quick. All right, this isn't going to be as clear as I thought it was going to be. Hang on one sec. Take the fib off. Yeah, I forgot we're looking at a 4-hour chart. Well, I'll just point it out to you. Here's the Asian range low, and here's the low formed at London Open, and then price takes off. Here's the low that forms at London Open below the Asian range, exactly Judas, and it goes up. Here's the Asian range low. Okay, price trades down rather precipitously, so that's not really benefiting you here, but there's an optimal trade entry it gives you here. The Asian range low here, again, same scenario, it wasn't much help to you here. Here's Asian range low, and this is the London Open, again, giving you the low, and you're buying in that situation. So everything you've already learned, okay, using the Power 3, short-term trading, and explosive moves video module, okay, all of those things combined, that's what happens when you get the 4-hour change in your direction off the higher time frame. That's what I mean when I say trade in the direction of 4-hour. It does not mean from that point on every single day check the 4-hour, okay? Once it gives you the sync with the higher time frame, then just stick with looking for a London Open to give you the low or high based on, and in this case it's the bullish scenario. You'd be looking for the low to form in the first couple hours of trading in London, and then trading with that mindset. Okay, and if you look at this example, I mean, we're not making this stuff up, guys. It's all in the videos. It's there. You just got to be able to break it down in bite-sized pieces and obviously digest it. But so again, the recap, we had the higher time frame premise of looking at 156.70. We found that on the weekly chart, then calibrated it with looking at the left side of our chart on the 4-hour. We zeroed in on the fact that 156.50 was a more apt level to expect a price level bounce at a time when an optimal trade entry formed with price action. Market flow changed to bullish. Okay, got everything in sync now. Okay, and now all you do is look for optimal trade entries. Now I'm going to illustrate something real quick to you, and then we're going to go back to that weekly chart. But now look what happens. We have the 4-hour giving you the bullish scenario here. Okay, so now you got a green light go. You're in a buy program. Look for buying opportunities. So now by looking at market structure, we have this high here to this low. We could reasonably expect price to trade up to this level here, and it does that here. Now let's scroll over real quick and see what happened. Now, is that not precision? You don't learn these things, okay? You don't learn these things as a brand new trader just sitting down at charts. You don't learn these things, okay, without putting time in, okay? You got to give yourself time. I didn't learn this stuff right away. It's by trial and error. I wasted hundreds and hundreds of fortunes, okay? I'm telling you, hundreds of thousands of dollars chasing stupid stuff, thinking it was going to work for me. And I'm telling you, this right here, this to me is the absolute coolest thing you'll ever learn in trading, okay? And this is what I just gave you right here. This is what made me a celebrity on America Online. This is the very concept right here that made me a celebrity. When I would call stocks to a specific price level, 3, 4, 5 weeks before it went there, okay, and it would trade right to many times to the penny in turn, and people were going nuts. They're saying, man, what is going on with this guy? And it was simply based on an idea that I got from Larry Williams' Target Shooter, and he used Gann levels, okay, but when you look at the Gann levels and the angles that were on there, it really just comes very close to these Fibonacci levels. And then looking at how price moves with market structure. So when you have all these things blended together, okay, now watch what happens. We got the bullish scenario here based on the higher time frame support level. Okay, the 4-hour market flow is kicked in gear here. So now we have structure, flow, higher time frame premise. That's a loaded price cinch trade. It's guaranteed. You're just going to look for one thing and one thing only, and that is what? Exactly. So now watch what happens. All we're going to do is look for OTEs in this example. That's all we're doing, okay? Just using price structure and OTE. All right, see this high here? See where I'm at? See this high? This is a hidden optimal trade entry, okay? Nothing new. You guys know about this already. See it? Now, that's one here, okay? Now look, we're going to be looking for retracements in every price swing going up. Every swing that goes up, you're going to be looking for a retracement to find another optimal trade entry. Do you see this price swing from here? You see it? Optimal trade entry. Now I'm sure what I'm going to point out, it's probably going over quite a few of your heads right now, and I'm going to come back to these examples and show something to you. And this is going to answer why there's so many levels on your Fibonacci tool, and the notion that eventually it's going to hit and stop on one of them. Well, I'm going to show you what all these levels do for you in a minute. Do you see this price swing here? Pull your fib from the low up to the high, optimal trade entry. Went right down to what level? The 79% level. Did it deviate much? 1/2 of 1 pip. Come on, guys. Seriously? I'm not done with market structure. So now you see this small little minor move here. It's still teaching you to look for retracements in the direction of the larger price structure. Okay, the market structure is suggesting this is going to be higher highs, higher lows. Okay, think about it. It's telling us based on this swing here, because this is the swing that traded down into that key support level. We're looking, as price continues to trade higher, we're not satisfied until we get a clear rejection and market structure and market flow break down together. And that does not happen anywhere in here. Okay, all this is continuing higher highs, higher lows. This right here, what is this? What classic price pattern is this? Bull flag. Exactly, it's an accumulation pattern. It's a trend following pattern. But what does it tell you? It tells you expect what kind of prices? Lower? Exactly. It looks like one of those camel patterns. Oh man, I'm going to be spitting tea all over my screen here in a minute. So you have a whole lot of things going for you in terms of buy signals, okay? But let's look at this one here. Again, using market structure, we're looking for price highs and retracing back into optimal trade entries, okay? Optimal trade entry here, zero, bang, right on the 79% retracement level. Not a pip lower, up she goes, okay? So all we're doing is focusing on price structure, looking for retracements on price swings that are moving higher. Exactly. This right here, this is, hang on 1 second. I got to get these little ones settled down. All right. So we have several optimal trade entries in here. We have this one here. 1, 2, 3, 4. Okay, and price continues to run on up. Okay. Now, look at all the opportunities that they gave you in an OTE. Okay. Look where they're happening and how they converge with the fib that you'd be pulling to make the optimal trade entry pattern. Okay, when I was drawing the smaller little fibs. Okay, note, okay, back at that same reference point of this low and this high, we have this range. We have this range here to be expected to be fulfilled on the upside up here. Okay, so as price is moving along, hang on. Guys got audio? Thank you. All right. Why do I have all these fib levels on there? Okay. A lot of you guys probably saw what was being tossed around on the thread today, and I more or less didn't say anything because I knew I'd be talking about it tonight. But if you look at how, in this example, okay, we have a bullish scenario. Look what happens when you pay attention to these levels down in here. Okay, granted, when we use the fib to draw an optimal trade entry, we're only really focusing on the 79%, 70.5, and the 62% retracement level. That's the ones that we're focusing on for entry signals to get in a particular direction. But when you have it applied to a market swing like we have here, this high pulled down to this low, there's your 200 extension. Okay, this is the level we're looking for in price. It's up here rather, up here. Okay, we're looking for price to run up to that point. We don't know how long. We have no idea, no assurance of any time factor that how long it's going to take to get to that point. That's not what we're concerned about. Okay, what we're concerned about is we want to be focusing on opportunities that every time it retraces, that price will hopefully try to get eventually to that price point. Now, when it trades at that point, we are no longer interested in being a buyer, especially if we see a rejection and a breakdown in market structure. Okay, and we're going to cover that now. But look more closely to what's happening. These lower level fibs, okay, below this high, what's happening at these levels? Up here, what's happening up here? It's exactly support and resistance. Okay, you want to be watching price when it gives you these drops inside the larger price range in this market structure. Okay, every time the price drops down, you're going to see these levels be impactful to price. Okay, now I know a lot of you guys like trend lines and all that, but if you're looking at trends, okay, is it not making higher highs and higher lows? When we drew the optimal trade entries on the smaller time frame swings in the direction of this price structure, it was lining up many times like this one here, this one here, this one not so much here, but look how much we had inerrant wicks here, but the bodies of the candles really maintained close proximity to this particular level in the fib. Now note also these levels that were acting as resistance and support resistance here, here, okay, and then ultimately up here. These levels were determined when price started to run from this low. So weeks before we got to this level, we knew all these levels were going to be probably impactful. Okay, so you want to look at these levels also to line up with your 5-minute pivot points, your Trader's Trinity matrix levels. These lines, I'm telling you, these levels are significant when they converge with other support and resistance concepts. If it overlaps with a Asian range high or low, it's significant. Okay, look what's going on here. Here's the Asian range low. It's right on that level. What happened with price? Zoop, up it went. Asian range high, right on that level. Okay, where did price go? Right from there, down. Look how close the Asian range high is from that level here. Asian range high, right here. I thought I saw here. Sorry. Asian range low. Asian range low. So there's a lot of impact with short-term price action when you blend these things together. And we're going to talk more about these fib tools and these levels in here and why they're impactful also as we build on the trading plan modules and more Pro Traders Club stuff. So a whole lot more to Fibonacci, trust me. Now, do you see this low here? When price comes all the way down and blows out that low here, after we hit a higher time frame price swing like this, and we went up to 200 as we did here, and it comes all the way down and breaks this low, market structure has now effectively been broke. Okay, it's essentially been broken. So now we don't really want to be gung-ho about buying this market anymore. Unless it gets back in sync, you know, everything starts to change, then you want to be a buyer again. But look what it kept you out of being an aggressive buyer in here. You could still be catching some swings very short term, but you're not getting in there trying to marry the vein, okay? Until we get market flow, market structure, everything back in sync, and it breaks here. So now same caveat happens. You start looking for your buy scenarios. Using this reference here, this high down to the low. And same thing, you're just looking for these levels here to line up, giving you optimal trade entries, optimal trade entries, optimal trade entries, and looking for high time frame support and resistance levels to line up with it. Everything's got to be blended together. Okay, and we don't have any reference points in here for key support and resistance levels, so it's really not going to be insightful to you here. But that's using the weekly chart, finding a level, using the horizontal line, building a stage for support and resistance to be an impact to trading. And we're going to go back to the weekly chart real quick. Okay, and now since we calibrated the 70 level, look what happens when you look at the 50 level. Same thing jumps off at the chart. Bodies of the candle, just high, bodies of the candle, bodies of the candle, low, body of the candle, low, high, high, high of the candle, low of the candle, bodies of the candle, bodies of the candle, high, low, low, bodies of the candle. Okay, so hopefully you guys can see that this level is impactful. Okay, it's very significant. Okay, now before I switch from the weekly, we'll go down to a daily. Yes, before I do that, I want you guys to see what I've told Pip Hanger when we were building his trading plan. I told him to really focus on the big fig and mid fig levels. Okay, and if you use that, you can see, look at the turning points that transpire when just looking at those levels. The solid lines are the big fig, and the smaller level lines are the mid fig, the 50 levels. This is where you should start. Okay, this is where you should start for your support and resistance levels. If you just focus on the big fig and mid fig levels and just look for opportunities around those specific price levels, it will make your key support and resistance level hunts a lot easier. And you know what you're doing. You're going to be looking for a trade at the fig or a mid fig. Is that easy? That's it. It's it. That's all you're looking for. Okay. You'll find, believe me, you'll find trades if you understand what you're looking for and you understand what the higher time frame directional behemoth is based on and where we're trying to reach for, higher or lower. And I'm telling you, it'll make it a lot easier for you as a trader. So let's drill back out. I'm going to take that indicator off. Asia range, we don't need that. All right, we're going to keep the 50 level on, and we're going to go down to a daily. Let's zoom out a little bit, get some more data. Okay, here's the high, some lows back in here. This is 2009. Look at the action here. Look at the low, look at the high, the high. Look at all the highs in here. Look at the lows here. Look at how many times the bodies of the candle, even though we swept below it with the wicks on the candle, every single one of these candles stopped right at that level. Look at how many times it stopped it here. And this is 2012 of this year. And then we have price action as we have it here. Okay. Now let's drill down, keeping that same level on a 4-hour. No, they don't use robots. Oh, man. And we're going to use the 1-hour chart. Same level. All we're doing is drilling down using that same reference point. And a 15-minute chart. A 5-minute chart. Okay, and that's essentially what you'd be doing. You'd be taking a higher time frame weekly, finding a level you like where we're close to right now, and I would look, when you do your analysis and you're looking for key support and resistance levels that are impactful for today's trading, right now today, I always look 300 pips up and 300 pips down. From wherever we're at currently at the time when I'm sitting down to do my analysis, I'm looking 300 pips up and 300 pips down. Okay, and the reason why I picked that number is because the average daily range, if you just want to use a base benchmark number, it's 100 pips per day. And I know that if you go and pull your average daily range indicator that ICT or whoever else you got your tool from, it's probably going to say the average daily range is for British pounds going to be 122 or it's going to be 97 today. It's just go with 100 pips, okay? It's very simple. Go with 100 pips, and my analysis is based on look at the last 3 days. So there you go. You got 300 pips. No problem, man. Thanks for coming out. The whoa, guys, you're gonna have to keep your messages short because I can't see it all. Yeah, I just expanded it. Thank you. Look at levels you haven't chosen and why. You can okay. All right. Well, let's do one better than that. Let's look at what I would do right now. Looking at the chart, what levels would I be looking at? Because I haven't given you my institutional levels since obviously we had the Greece vote. So what I would do is I'm going to look at where we're at right now, and I'll give you the levels real time, real quick, and I'll show you how fast it takes for me to go through it. And once you get some practice, you'll be able to do the same thing. I'll go to the weekly. And all I'm doing is I'm looking for the lows that are very discernible. Okay, obviously you know where we're at here. And all I'm doing is eyeballing it. I'm not trying to get to the exact high or low, because as we drill down to the lower time frames, I can clearly see where the high and low would be, and I'll just calibrate it there. You don't have to be looking at the candle. What's the high? I don't care about that. Okay, I'm just getting a rough idea, because support and resistance is going to be a little gray area anyway. You can swing 15 pips above it or below it, and I allow for that anyway. So we have these levels in here that are clearly noted. I drop down to a daily. Okay, and the same practice we just did on the weekly chart. Now I'm on a daily. So what I like to do is I like to change that to a different color. And red just more or less gives me an indication that it's from a weekly chart. Okay, and if I want to look at the monthly, and right now we're not at a level on the monthly chart that I would be really excited about. So I'm just going to focus on the weekly. This color is what I use for the daily. And I just more or less move from the high and where we're at right now. Here's the market price that we're trading at now. And there's 100 pips, 200 pips, 300 pips roughly. Okay, and in that vicinity, I would be looking for any significant highs or lows. And I like the 160 fig. And the reason why I like it is if you go back, number one, it's a big fig. Then you have these highs, this high, the highs in here, the lows, the lows, the lows. Again, when you're looking for support and resistance, allow for the wicks to move beyond these specific levels, okay? You're not going to always get these perfectly black and white levels where price is never, ever, ever going to go below or above, okay? If you think like that, you're going to struggle. Look for levels that hopefully you can see that this is a very important level. It's caused price to react to it. I mean, you can see it. It's bounced off of it, okay? And don't be surprised if you pick a level, okay, that it moves beyond it and you get stopped out of a trade. Don't abandon that specific support resistance level. Price may come down, you know, and stop you out and then rally up, and then that's where the swing you would be using for the optimal trade entry. Pull your fib across it again, and it may trade right back into that key support level at the entry point at a kill zone. Okay, don't abandon the level. Okay, I see a lot of these guys talking, well, you know, this level's dead because it, you know, it traded to it once and there it is. No, it ain't. I don't believe it. I don't subscribe to that. I have no idea why they have that idea that just because price has already touched it a couple times, it's no longer valid. I'm using examples from 2009. 2009. How many times has that level been traded to in the last 3 years? A lot. Okay, believe me, there's fundamental reasons, and I don't know what they are, but there's fundamental reasons for price to be reacting at that specific level. And I'm not going to go into an exploration as to what it was that was the caveat behind it moving price. I just want to see, okay, well, last time it traded there, it did this. So that's why I'm going to be looking for it to happen again, because history tends to repeat itself, and people like ourselves, you know, we're habitual, you know, creatures. We do things by habit. And human nature being what it is and psychology what it is, well, if the price of potato chips are 50 cents and it goes to 80 cents, we're probably not going to buy a whole lot of potato chips, but if it goes back down to 50 cents or 45 cents, hey, you know, we're going to be buying a whole lot more of it. It's supply and demand. That's basic support and resistance trading. So when you see these things happening, okay, you just look, you know, identify it on your chart and just watch it. So obviously the 160 fig is still obviously a level that's of interest to me. We've talked about that in our reviews. Moving down. And really what I do is I find the highest level I'm looking for, and I start going down to the institutional levels from that point. Okay, in this case it'd be 159.80, and you can see how just by keeping the big fig, I know in my mind if we're going to go to the big fig, or if we're starting to trade up to that level, I'm going to be watching that 80 level, because we may not get to the full fig, and 80 may hold it back, or 90 may hold it back. So I'm not going to be so interested in here, because if you look at the highs, and I'll give you an example of what that looks like here. Here's a high that's kind of close to the big fig anyway, and it's a little bit above 80. And we have a high here, and look at the lows in here, and the bodies of the candles and such in here. So I'm not really interested in noting that one because it's so close to the big fig. It'll accomplish itself by just, you know, being on the lower time frames and watching price. The next level I'd be watching the 59.50 level. Okay, and if you look at 59.50, again we have similar price action. We have a lot of the bodies of the candles in here, highs, bodies of the candles, the lows in here, and the fact that it is a mid-fig level, okay, goes without saying. I wouldn't necessarily have it drawn out like this. It's something I'd just be monitoring. The 20 level, it's hard to see in here. I'm sorry, I can't make it clearer to you. This one in here I might have because obviously it's one increment above the full figure at 59, and the fact that we have this high here, this high here, the bodies of the candles and highs and lows in here, the low in here, and the bodies of the candle and the low back here. So I would probably leave that on my chart. So 159.20 is the level I'd have noted. I'd grab another horizontal line. I'd look at 59.80. I'm sorry, 58.80, simply because the 59 fig goes without saying you'd be watching that anyway. 58.80 rather. Another level, I probably would have this drawn on my 4-hour chart or 1-hour chart, not necessarily the daily. The 50 level, 158.50, I like this one, and hopefully you can see why. It's very clear. We have the high here, all the lows and the bodies of the candles in here. Look at how many times price held the bodies and the highs. So that's a nice level. I'd leave that. .58 fig, again, no need to really note it because it's something that we'd be watching anyway. Every time we get to a full figure, full figure, 100 pip marker, that's something you'd be watching anyway. 157.80, obviously I like that one a lot. We have this low here. Look at how many times it bounced off of it here. All the highs in here. Look at the wicks and the bodies of the candles. The low here, the bodies of the candles, the low here, okay? And look how close we are in proximity to that level, 157.80, okay? $157.80 wasn't on my chart. Nope. Wasn't on the reviews now. But we were trading back down here as well. And before we get to 80, we would get to 30. Down in here to up here. It's a little bit of a distance. There's other levels that we had to get through. Here, all these levels here, just simply because I'm not trying to take the levels off because I think they're going to be impactful later on, and it's just much easier for me to grab the chart, the level on here, like this, and just drag it out when price eventually moves to that level, should it do it. That's all. They're just key highs that I have referenced on the chart based on this high here, this high here, this high here, this high here. And it's honestly, it's a matter of laziness on my part. It's just much easier for me to see these and go back there and just pull it across my chart that way. Just go back to our chart we're using now. Okay, so the 57.80 I like, and here's the reasons why. Now I wouldn't keep the chart like this. I would go and start putting the um, line segments on. I would take the little trend line thing here, and I would find a high or low that lines up with one there, like we have here. Okay, I would probably draw it from this high here across, and you've seen that on the other chart. And I would take the whole horizontals off because I don't like it across my entire chart. It's just too much going on. So this is what I do. I find the levels with the full horizontal, and then the ones I want to keep or like or I think it's going to be more impactful, I'll just draw segments off of that and then delete the full line. Does that make sense to you? In other words, all these lines right here would eventually evolve to that in terms of shortness. I just don't like that line going all the way across. Yeah, it's too much because it's starting to give me a headache looking at it like this. Again, you just grab another line and just pull it down, and I like this one because we have this low here, these highs and lows in here, okay, and that level is 157.30 with no surprise because that was one that was on our charts and the market reviews. And obviously you would continue going lower for the 300 pips down, and I wouldn't go beyond, say these lows in here. So 154, 154.50 is probably be the lowest I'd be considering for support for the remainder of this week. But this high in here, this low in here, those would be levels I'd be watching. So the 156 fig, 155.80, 155.50 levels, those would be interesting. How do I know which level to look for at, hold on, how do you know which level to look for a trade at? All right, well, let me give you an example of that because I'm going to need to put the chart lines on for this. All right, this is a low. See these lows in here? Okay, so here's the levels that I think you should have been watching. If you were absolutely gung-ho and you needed to be in the market and you didn't care about the possibility of having ridiculous risk on if the central banks made an intervention because of Greece not going how it did, you could be looking for these types of support and resistance levels. And that's drilled down to a 15-minute basis with these levels in mind. Okay, and we used the higher time frame daily to arrive at these levels. Okay, so and all we did was we found them on the daily chart and the weekly chart, and then zoomed down with those levels into this particular price time frame, and this being the 15-minute time frame. All right, here's a high. This is the 157.30 level. So price ran up, hit that high, came down, came back up. What's formed here? Okay, so the question is how do you know what level to look for a trade at? Okay, well, when do we trade? Let's start there. When do we trade? Kill zone. Okay, so if you're trading in 1930 GMT, what are you going to look for there? Nothing. That's no reason to be in that market. 1930 GMT, that's after 1800 GMT. We don't do anything. Okay? You want to be looking for London Open. You want to be looking for New York Open and London Close and Asia. If you feel like you have to be in there and you don't really want to be making a whole lot of money, there it is, Asia. Okay, but let's look at what this works out to be. If you're a higher time frame support and resistance student and you understand that price when it gets to these levels as we have here, this is that 157.30 level. Okay. Yeah, that's right, Aaron. But I had to give it because I'm sure everybody's going to ask. You know, you can make money in Asia, okay? And don't beat it up too bad. You can, but it's just it's not as easy as it is if you understand the other kill zones. All right. So looking at this level here, we had 157.30 for well over a month and a half on our charts. Okay, it's been a level we've had noted. Okay, we've talked about it. This particular price action, when it hit that level in price, this is a 15-minute chart. And this is 21:45 GMT. It's very, very late, very, very late. Okay, and in here it rejects it at 22 GMT, trades down, then it rallies up, runs into it again here. Okay, this candle occurs at 0:00 GMT. That's the very beginning of the day. That's your Asia trade. Okay, this is an instance where, and we happen to be making fun of Asia, it just so happens that this is the setup that would have paid you trading the Asian session. Look at the Asian session video, trading the Asian session, and you'll see this is the exact technique that's illustrated in that particular trading course, or not course, but particular trading module for trading the Asian session. It's removed? Are you sure? Because I was just watching it the other day, because I like the Asian music in it. Yeah, I was gonna say I I just watched it the other day, and I haven't deleted any videos. So the question is when do you trade off these levels? Well, you got to look at time and the price and the reason to be doing anything. Okay, so here's time of day. This is Asia. We already learned in on trading video that Asia typically is unwilling to make new highs. Okay, it's like here's the high here in New York. If we're trading at a key resistance level, it's typically unwilling to make a new high, and that tells you that optimal trade entry is a very strong candidate for a short. And the optimal trade entry sweet spot lays right with the 125 entry point, which is only 5 pips away from the 30 level that we would be watching. There's your trade. Okay, where's the Asian session trade down to? Right down to that old low right here, and then it starts to peter up a little bit and it goes up again here. Okay, so that's one example how you would use that one particular price level that we were watching and stalking. Okay, that 156.44 level, which is essentially the 156.50, or if you want to be really tight, you can use a small number 40. Here's 40. Okay, and price trades down to it here. This candle is New York open, trades up. This candle here is London close. Okay, London close. Here's the low in New York. Here's the rally, the retracement, London close, trades on up. Now it's slow, but still trades. Okay. Now, between this level here and this level here, what price level would be of interest to you? It's a significant one. Big fig. Now, Here's the 57 level, okay? Here's 50, and the other 50's up here. This fails to get to the big fig, okay? Fails to get up there. If you always expect price to get to that full figure for your entries and not willing to accept the fact that it may not get there, you're going to miss trades. Okay, you're going to miss like that. I mean, that's a nice trading opportunity here. Okay. There's 80. There's 56.80. That's the institutional level for 20 pips below the big fig of 57. Do you see this low here? And this low here? See them? Hello? You guys lose audio? Okay, thank you. Here's 80. We're going to go up to that low. So here we have a low here. We have a low here. What price level is this? Small round number. Okay. See how price is just moving slowly sideways in very, very tight channel? Here's a level you'd be watching, 156.90, based on the left side of your chart, support and resistance, the fact that it's a round number, the fact that it was approaching a full figure, 57, okay? We traded off of a key support resistance on the higher time frame, and we've been trading lower. There's only been one significant price swing down. Then we went sideways to up, okay? So we've more or less retraced. Yes? Would anybody agree? I mean, we've kind of retraced into this decline. It's rather mute, but it retraced nonetheless. So what do you do in that instance? What do you do with that information? Think now. Exactly. So if you're a higher time frame premise trader and you like support and resistance, here's your high down to your low, okay? Here's the fib at 50, converging with the 56.90 small round number with an old support resistance, okay? What time of day is this? London Open. What time is this? It's a trick question. It's still London Open. What's happening here? Okay. You see how we're doing? See what we're doing? We're breaking the market down from support resistance, support and resistance on a lower time frame, and then support and resistance on a lower time frame, and then looking for reasons to get in the trade based on that idea. Okay. So we have a 90, a 50% convergence with the fib based on this reaction. Why can't we fib the 17 high to 19 low? 17 high to 19 low. We haven't got to that example yet. I'm getting there. No problem. No problem. I'm just illustrating how you can trade without the bias, because everybody's, they're really, really upset about not being able to know the bias. You can make money without having the bias, okay? And just by using support and resistance and a higher time frame premise, okay, you can capture these types of moves. Would you not agree that this is a level that's very clean? See these two lows here? Now, what happened prior to these lows forming? We ran up, yes? You don't think there's people that's trailed their stop loss orders? Where were they trailing to? Right below these lows. All right, I'm long. I've been long since the 15th. I'm obviously talking hypothetically and as an example. I'm long, and I'm going to have my stop loss below these lows. I'm trailing it up because we've consolidated sideways. Now it's going to continue higher. There's your pocket of stops. There's the raid. What time of day is that? London Open. What is the paramount characteristic that's associated with London Open that you need to know? What is its characteristic? Which essentially is what? What action is exactly stop raid? It's a stop raid. London Open is a stop hunt. Okay, have that in mind. That's the reason why the initial move in London Open is many times 80%, and I'm really roughing it. It's probably closer to 70%. 70% likelihood of that being the opposite of the daily range. In other words, the first couple hours, whatever that initial surge is, up or down, many times you'll see, to study what pair you look at, many times it'll be the false move, okay, and it'll be a sucker play, and it's usually reaching for a particular high or low from a previous day or previous market session, and take out the stops, and they use all that liquidity to get the market, players trapped and take those that were right on the market. Because think about it, the guys that bought on the 15th, they had their stop down here. They're in the market correct. So if it trades up to 57.30, 57.50, okay, they're going to make money, aren't they? So think about it. You want to get a ride on the train to 57.50, but the seats are full. Well, what do? You either wait for seats to be available, or you throw them off the bus. That's what happens here. Okay, they blow out all the guys that want to trail and still protect. Okay, and that's why I'm not a real big fan of trailing stop losses unless I'm day trading. Okay, unless I'm day trading and I get into the 1500 to 1600 GMT profit taking window that we like to use, the London close. That's when I start ratcheting up my stop. I'm more of a fan of scaling out profits in the direction of my trade and leaving my stop outside of the daily range until we get to the 1500 GMT, because I understand what dealers do. They want the liquidity that my trade and everyone that trades like that would give if we trail our stops inside the daily range. Okay, and what does that mean? Well, when we raid this right here, this is a run below this low. That's where all the stops would be. Just continue this rectangle out, and you'll see they clear, and they really reach down for those that say, okay, I really want to be protected. I want to be 30 pips below the lows. Well, they got those guys too. Okay, and then rallies it up. Now we have this level here, 56.40. Okay, that's a key support level on this time frame now. If you use this level, okay, and we're going to leave this level here like it is, okay, and the rally that ensued in London Open, and then we have a retracement, okay. If you use this low to this high, you're not going to get optimal trade entry, are you? It's going to be too high, isn't it? I'll show you what I mean. You're not even at the 50 level. It's not even at the 50, okay? But what did we learn a couple weeks ago? You see it? You'll catch on. There's your trade. What time of day is that? So the question is, how do you know when to trade at what level and look for a trade? Well, these levels we just determine from higher time frames down to a smaller time frame to a smaller time frame to a smaller time frame, and then looking to the left side of the chart where the key higher lows are. Okay, understand that London opens the raid. It usually sniffs out particular highs or lows to run the stops and scare folks, scare them. I mean, think about it. This is a 15-minute chart, and you're watching price do this. Slam, 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 slam. If you're a new trader, I'm going to tell you right now, when you're watching price slide down like that, when you're watching it do this, you are not thinking buy. And if you say you are, you're a liar. If you're brand new in this, you are not looking at that as a buy. You're scared. Believe me, you're scared. And you're either looking to get short or you ain't touching it because it's too scary. Okay? Now, as a trader with a plan, okay, you're going to be looking at that as, okay, well, this is an opportunity for me to make money. So now think, we saw this action here off of this resistance level, support now rather, and then cleared out the stops. What do you see here? What is this? It's a big one, isn't it? You guys are used to seeing a couple pips, like 20, 30 pips. And that's a pretty good one. They'll take it far enough to get a particular higher low, and the stops were below here, so they ran it down here. All right. What happened from that point? Now, did we get to 200? Mm-mm. 200's up here. What's the 200 level sitting there? $157.80. What's price doing right now? Now, what do you think is going to happen if price trades down initially in London Open? What would you expect? And then what? Price action to where? To where? Okay. So that's how we're talking. We're looking for opportunities now. Okay, you're asking, how do we know what level to look at and what to do with them? We have an unfulfilled 200 extension up here, converging near 157.80. Notice also, where are the stops right now? Ask yourself that. Where are the stops? Would you not agree that there's stops above these highs for folks that have been trying to short the market? They're sitting in profit right now, aren't they? Marginally, but still profitable. Is that not? It's not that high and this high. That's clean, isn't it? It's very similar to this. That's where the buy stops are right now. You have to think ahead, okay? Because that's what the dealers are doing. They have orders that they have to fulfill, and they have to provide liquidity for, and they need participants, okay, to be on the other side. So they have to give other opportunities for pairing of orders, and you gotta think like them. And until you develop that skill, okay, you're going to be struggling. I'm sorry, unless you have something purely mechanical where it has no emotional or thought process on your part, and you just follow black box generated signals, which I just think is nuts. You got to have some discretion. You got to have some discretion in your trading, because if you don't, you're blind. I appreciate that. Thank you. All right, so that's where the buy stops are, and even if we run up there and hit the 80 and then reject and start to trade lower into the week, that's still a possible scenario. But I like the 57.80 level. There's a lot of things suggesting there's some interest up there, and we do have an unfulfilled 200 level from this swing down. And let's go back down to an hourly. And the question was, why can't we use the low? What was it, the low on the 17th? Somebody asked a question about it. What specifically was it? 17 high and 19 low. Okay, thank you. Use the 17 high to the 19th low. And we're using what? We're looking for what specifically, you asking? Are you talking about pulling a fib from this high down to this low? Okay, I follow what you're saying. You could have, yes, to answer your question, if you were a bear and there was a reason to expect uh, um, shorts, you could have done this. You could have used this scenario. Okay, and your optimal trade entry would have been in this area here, or you could have used the larger price swing down when it made it. You could have been looking for shorts here if you had a bearish scenario in mind. Okay, but you have to look at what price structure is doing. When we made this low, when we made that low in the cable, okay, see how we went down below this low here? You see that? Watch what happens in the fiber at the same time. This is that same comparable low to low. What is that telling you? More specifically, what is it telling you? Somebody with a big hand is accumulating long positions. So you see something like that, and you've also been in a bullish scenario on the higher time frame, and we've been in a higher high, higher low scenario for a couple weeks. You don't want to be trying to pick the top. Okay, you don't want to try to pick the top in that. So no, you don't want to be looking for shorts. You want to be looking for your optimal trade entries to get long. Okay. So that's the reason why you wouldn't be taking the high down to any lows looking for optimal trade entry shorts, because the most recent price structure, okay, sorry about that, I moved farther into my home and I happened to be outside the room. My son just took a pee. Yeah, folks, I'm human. So is my offspring. It does itself. It does itself. The this lower low here, okay, this looks bearish, but you have to look at what's been going on in your correlated pairs. SMT divergence for fiber was saying, no, this is suspect. This is a stop rate, okay? And that's how you justify um, looking for your buys for the day, okay? SMT called it. You don't look for shorts. That's the moral of what we're saying here. We're bullish, okay? We ran up, and all this is what? We talked about it earlier at the beginning of the presentation. What is this right here? Exactly. Consolidation is accumulation. So we've consolidated here, rallied, consolidated. What does that mean? The next leg is up. Should be reasonably expecting another up move. Okay, so we're still in a situation where we would expect higher prices, but we still have to expect that today may be an up day, initially, but we may go into a reversal day market profile. Okay, so you have to have that in mind because we've been steady pushing higher, higher, higher. And if you go to a daily, it's been one-sided. Okay, so there's a lot of things that go along with just the support and resistance idea, but having the levels and then using time and price, kill zones and such. Wow, you see that reflection? Sorry, it just it just jumped off at me. I had to. It's really nice. Wow, and even railroad tracks at the top. Sorry, I'm a nerd when it comes to this stuff. I just absolutely blown away with how price structure and it's so much symmetry in the market when you understand what you're looking for. And yes, it's a turtle soup. Turtle soup is a false breakout. In other words, here's a high. Traders that would have been expecting price to trade up. Because think, what's this right here? We just got done talking about it. What is this? What's all this price action in here? What's going on? Right. What are they accumulating? Short positions. They're accumulating short positions. It's not always accumulating longs. Accumulation is not buying. It's accumulating a net position, either net long or net short. So they're allowing folks to do what? They think it's going to go higher. So they keep pairing orders up, saying, okay, yeah, keep buying it. So they rally it up a little bit. Folks buy all that initial break above all these highs. Gosh, man, see how easy it is for me to get down rabbit trails? I apologize. Let me hurry up and finish this and then go back to what we're talking about. But they run up price above these highs and trip the initial buy orders, okay? And the price starts to trade down like this. And the guys think, yeah, I got it right, because those suckers that went in here and bought it, okay, we sold at those highs. Trades down, they feel great, okay, but then there's other guys saying, wait a minute, if it goes back above there, this is going to be the buy. I'm going to be catching the buy, breakout there. So they're going to get two camps with this. They're going to break out artist snare here. In other words, the guys that want to be buying a breakout above this high, they'll have orders resting above it right here. And those that have went short, thinking they beat the market, will have their buy stops resting above that. And that's what happens with the reflection. They'll come back for those orders, run them, and then all of a sudden when they see it reject, nobody wants to get back in the market now because they're scared. And then there you go. You see the price run down. time of day on this is New York Open, and that's kind of neat. It looks like London Open, but that's I think that's non-farm payroll. As a matter of fact, I know it is. It's non-farm payroll. So, oops, I grabbed that level and I didn't want to. Hang on one sec. Having fun, huh? Well, this is what the Pro Traders Club is going to be like in September. Same thing you did tonight. Just sign on. No catches. No problem. Take care. I appreciate you guys coming out. But let me wrap this up for you guys because it's summertime and the kids have well beyond their normal bedtime, and I want to get them settled down. So looking at where we're at right now, obviously, comparing the two markets, we still can reasonably expect another push higher. We always have to be careful because we have been going one-sided, so we may have a scenario where we drop down to give a buy in London Open and then rally up to get to the 57.80 level, and maybe if it has a lot of excitement behind it, maybe even hit the 58 fig because it can do that, and then reject or reverse at London close or New York Open. So you might rally up into a market reversal profile today. If we stay in this consolidation and just run up above these highs and reject, I would not be chasing any shorts simply just by doing that. If it gets up here and then we reject and then we do an alpha trade entry going into New York Open, I would be interested in taking that one. But I'm not interested in shorting anything. Just because we blow out these highs, that's not enough for me to look for a short because we're trading against the higher time frame daily premise. So that's kind of like what I'm looking at and anticipating going into London Open. Still not real excited about the aspect of just being in the market right now because it's Wednesday. Because I said Wednesday would be the day I'd be looking for trading. But obviously, if it sets up and gives us these scenarios, then I would be taking some action. But New York Open looks good too. And yes, all my children are going to the bathroom. Would I be doing this again tomorrow? What is tomorrow? Wednesday? Now I don't think I'll be doing anything, but I could probably meet with you guys for a little while on Thursday. Maybe do some pre-market analysis for Thursday. Give you some ideas. But my main point was to cover the 57.30 level, and hopefully I did that tonight for Ali Shijo. I hope I'm saying that right. Um, you're very welcome. I love doing this, guys. I absolutely love it. I don't like the fact that I can't record these, and I'm afraid if I tried to record, because I do all my communication with you guys on a laptop, I don't like connecting the internet in chat rooms and websites with my main computer systems. I just don't trust anything getting to those. And any tips for waking up for your alarms? Yeah, turn the volume up. You got to give yourself, a routine, and don't drink anything with caffeine, because when you drink caffeine and it finally burns off, it will actually cause you to have um, a deeper sleep, and you don't want that to happen, especially if you're, looking to try to get up at London Open. You got to get yourself on a schedule, and I'm on a very weird schedule. It's naps. That's all I do. I don't have any long periods of sleep. That's exactly right. It's very difficult for me to get to sleep. When you don't work hard and go to 9 to 5 jobs and just get beat up all the time with that type of stuff, it's actually like difficult because I don't really get tired enough to fall asleep. So it's I guess it comes along with the lifestyle. I guess I'm not sure how to. That's what I come away with it. Yeah, stuff a couple months ago. My average is about 3 hours if I can get to sleep, and that's in the nighttime. But I'll get up, set my orders, check my stuff, and then fall asleep if I'm in something. And if I can take first profit, I'll try to get a nap in. If I had to have a job, let's put it this way: when I had a job and had to get up in the morning and be out in Owings Mills, I slept more then because I was really exhausted. When I went to sleep then, I slept because I was doing a job and I was actually doing a lot of analysis and study. And just how you guys get excited the by doing all this stuff and seeing it and seeing how you could possibly use it in the future. It's fun. It's fascinating. And now that's what was I was addicted to that when I was actually doing my job. I would think about things and I'd say, oh, well, when I get home, I'm going to check the corn market and see if it was doing this, or I'm going to check the live cattle market and see if it was doing this. Oh no, yeah. By the way, if wheat was going up the other day, if wheat's going up and soybeans are going up, it probably means that oats are probably going to get ready to go up, or soy meal is going to go up, and all those types of things would just propel me. And everybody's running around drinking these 5-hour energy drinks. Dude, let me tell you something. You get hooked on technical analysis and you're a newbie and you start to see things. 5-hour energy gain got nothing on you, man. I was literally burning midnight oil every single night, every single night. But when you stop working, you don't feel tired. It's hard to it's hard to get tired if you're just doing this for a living, and it's boring. That's why I like doing this stuff because I know what it feels like when you guys see these things and it's exciting, and I get a high off of that. So time well spent is obviously on a higher time frame and intermarket analysis. And I know you've been looking at the interest rate markets and the T-note markets and how does this work and how does all these things tie together. I think you're absolutely going to be blown away with the stuff I'm giving you in the trading plan stuff. I know you probably hate me right now because I've been holding it from you, but there was a real technical reason why. Because every time I would do my recordings with Cam Studio or Camtasia, whichever it is I'm using, um, the rendering would render and render and render, and all of a sudden at the last 5 or 10 minutes, and some of them were like 15 minutes, it would stop, close the rendering, so the recording would look like it's done, okay? But when I play it back, it would play all the way up to that point. The audio would still continue, but the frame would stop. So you would hear me talking, but the chart or the slide or whatever it was wouldn't transition to the next one. And I don't know what was causing it. So I had to go through the whole process of reordering, Smith Tech, whatever it is, the website I went to get this thing. Reordered it and had to go through some rigmarole with them because they're trying to tell me, oh, we're getting ready to have the version 8 come out. Why don't you just wait for that? I said, look, man, I've been trying to mess with this stuff for, a couple weeks now, and it's frustrating. I said, if I had a business and I was, selling an item or a product, I'd be going out of business because of this stuff. So I appreciate your patience with it. I think I fixed it. So obviously, because you can see the last market review was a little bit long, but the stuff that I gave in the trading plan module that talks about interest rates, you don't see this anywhere. And the reason why you don't see it anywhere, it's mine. It's his stuff that Larry Williams don't even talk about. And I've been to his webinars, and not webinars, his seminars, and he is a very big bond trader. But I'm telling you, if you don't ever want to trade Forex, okay, and you want to trade what I'm giving you in this one particular module, you can be an S&P trader, you can be a bond trader, you can be a stock trader, you can be a commodity trader. and make hand over fist more money than any of the average Joes out there that sell stuff, that have subscription plans, that sell informations or signals. It literally will tell you exactly what everybody makes a big to-do about. It. Like, how does he know when the market's going to go up like that? And how does he know when? I'm telling you, you will not sleep. This is going to be 20-hour energy drink for you. Okay. The the notion of knowing what interest rates are doing. Okay, and I'm just going to toss this out. Okay, because I think if you guys are completely against buying information, okay, you're really doing yourself a disservice, because there is one particular, uh, if you were going to buy one particular thing on the market on Forex, okay, it would be the webinar recording by Chris Laurie. And again, he's the only one I'm ever going to give a plug for, because what he talks about in his information is it's real worldly stuff. I mean, these are things that I've been using for almost 2 decades now, okay? And his understanding, much like myself, on the interbank level and the institutional level side of trading, his last name is Lori, first name is Chris. You can find him at chrislaurie.com. But he's the only, if you look on my Twitter, if you follow me on Twitter at ICT underscore baby pips, he's the only one I'm following on Twitter, because everybody else, I'm not trying to be rude, but I'm not interested, and I'm not trying to follow what Chris is doing in terms of trading, but I like his posts. I like the things he's sharing, because I mean, all around, I just think he's a really cool guy. I think he's grounded. He's not out to be a showboat. And if you've ever really seen any of his work, um, his interest in your success is absolutely genuine. You can really see in the ethic that he has with his presentations. You can see it in his delivery, um, his time that he spends in them. I mean, I can be long-winded. I mean, we've been talking for 2.5 hours, but his presentations go 6 hours. Okay, I mean, 6 hours. I mean, he takes a couple breaks for the rendering of his, the segments of his video recordings, but his attention to uh, delivery and making sure you really understand and have a genuine interest in your success, you don't really see that. And I bought a lot of his stuff, and the only thing I don't have is his Australian and yen stuff, and simply because I'm not a yen trader. But enough about that. I mean, I think everybody knows that, I really support his work, even though he does sell it. He has a boutique business where, he sells, you know, it's good information. I mean, like I said, I have all this stuff except for that one most recent course, and it's simply because it's specific to the yen, and I don't trade yen pairs. Um, a lot of this stuff, is understood by me because of the experience I've had being in all facets of trading. But his presentation of interest rate spreads, I thought, was a very good way of illustrating how the interest rate markets influence the forex. Okay, and if you apply what he tells you in the it's called the inside the banks webinar. Um, it's got a lot of other information. It's very, very useful, very, very useful stuff. But it's called Inside the Banks. And a matter of fact, I was just looking at it again. I went through it again. What are we in, June, May, March? It was the second week of March. I just went through it again, sat through it on a Sunday morning while I was watching it. And it's really got a lot of good information in it. If you start to watch it and it feels dry to you, okay, I promise you, try trading without having that type of insight, okay, and see your results, and then when you get frustrated, go back to that, because I'm telling you, interest rates are exactly what the secret is to trading, whether you're trading stocks, whether you're trading commodities, whether you're trading whatever it is, okay, and it's obvious. I mean, everybody knows what I do with interest rates. I trade based on a divergence, much like the SMT. And It is so absolutely disgustingly simple, okay? When you see the yields diverge, okay, it's that simple. You're getting ready to see a shift in the marketplace, okay? And when you blend that with a couple things you're going to learn in that module, okay, it's not so much that one country has a higher interest rate than another and just simply go in there and buy it. That's not enough. But for carry trade purposes, that's good. But when you have that and there's other facets included in that, you will get crazy trades. I mean, crazy stuff that just leap out, okay? And you have these really huge extrapolated moves that take a lot of traders by surprise. And I'm going to basically teach you how to call every major turn in the marketplace before it happens. You're going to know exactly what to do, when to do it, what to wait for, what specifically you're going to do, and when to do it. And I cannot make it any easier as a mentor, as a trader. It's not out there. I'm telling you, it's not out there. The closest thing that you're going to get with this work is Lori's presentation in Inside the Banks. Okay, so I I recommend just buying it. Just buy it. Okay, it's got good information. I didn't include what he put in it out of respect. Okay, and there's a couple things that I do that aren't in that thing, and it's my bond trading system. Okay, my bond trading system was the reason why I was a good S&P trader, the reason why I started becoming profitable in Forex, why I was not Forex futures. Um, Interest rates with the CRB index. Okay, that's all you need, and you're a completely light years ahead commodity trader. Nobody trades commodities like they should, and there's no books out there teaching how to trade commodities. Um, but if you understand, how much was this webinar? Good grief. Man, I don't want to say a price. I think it's $100, maybe a little bit less, something like that. Um, it's not much money at all. It's really worth it. I mean, it's got a lot of information in it that you just don't get. You got to have, an understanding of the marketplace on an institutional level and an interbank level where you actually see things going on that the retail traders don't really see. And obviously, if you don't have his basic course that he calls the advanced course, I mean, that's like his basic stuff. Um, but there's a whole lot of other stuff that he teaches that, I would recommend just buying it. I don't get anything for it. I don't get any commissions. He's not giving me a kickback. He didn't ask me to do this for him. I'm just telling you, being the level of experience I have in the industry of trading and what I've spent money and wasted on because of just it's a hobby for me just to go out and buy what's available. Because honestly, I'm waiting to see somebody go out there and try to reinvent what I'm putting on for free. I know it's coming. I know it is. And Steve Morrow is the closest thing. Okay, he's so close to what I'm doing, it's disgusting. Okay, and all these things, okay, were talked about in other forums and that nature. But the bottom line is don't be against buying good, solid information. And if I come across something I think is good, and it may be somebody else that comes up at the at the grain and is a good trader and is a good mentor and has a good product, I have no problem telling you, it's good. I'm not going to copy it and put it out there for you to have. I don't like doing that. Um, but I think Lori's work is good. But if you're going to get one particular thing, get that one. And nobody really talks about it much. And if you're a fan of Chris Lori, that one, for for whatever reason, folks want to see what we're talking about here inside the banks. Yes, guys want to get in here and they want to see, give me a chart. Give me a chart, Mr. Trader Guy, Mr. Mentor, Mr. Know-It-All. Give me a chart. Show me how to get in there and buy, and show me how to sell, and show me how to make money. I'm telling you, I said this from the beginning. You will absolutely fail. If that's all you want, you're going to fail. Because I already gave it to you. And nobody's running off, making $100,000 a month. Nobody's doing that right now. You need to develop a lot of things, and it's a lot of internal things. And then after that, you have to have an understanding of what drives the marketplace, because you can have the right psyche, you can have the great trading plan, the great buy signals generator, that you have in terms of support resistance. But if you don't have the institutional sponsorship behind the setup, it's not going to move for you. It may move a little bit, but your ability to see the magnitude of the price swing that you're trying to trade will be limited. Okay, for instance, this setup here, this drop down in here, if you're a new trader, you might think, okay, well, it's going to go up and it goes up 30 pips. That's the end of the move. Well, then you would have missed all that. And if it trades up to 57.80, you've missed that as well. Okay. Did anybody else lose audio? Okay. Um, but anyway, Chris Laurie, I didn't do a whole lot of interest rate spreads. I mentioned it briefly. I talked about it, and obviously the yen being zero in terms of interest rates, and then Australian dollar at some point had a pretty good interest rate. It allowed for a carry trade opportunity. I talk about how you can go and track the world's interest rates, and there's a website out there. It's kind of pricey, and I thought about tossing it in there, but I didn't because I know there's a lot of people that just aren't going to be able to do it right now. But maybe later in the year I'll toss it out there because it's kind of expensive. But I think if you just get it in there and subscribe to it for 1 month, get the historical data that they allow you to download in Excel, and then it's a matter of you just keeping track of the interest rates globally, on the major countries, and then you'll have the data, and you can create your own interest rate spread charts and compare the two. And when one is going up and the other one's going down, you can get the same information you learned in Chris Laurie's course. It's a little bit of work involved in that, guys. I'm not trying to make it sound like it's very simple, but that's the homework aspect of where the majority of your time needs to be. It's not staring at 5-minute charts. Okay, bank traders do not do not spend all their time looking at 5-minute charts. Okay, they look at the macro view and they drill down to that smaller time frame to look for opportunities to trade within that environment. So, like I said, it's going to be expensive in terms of time and effort and work. But if you put the time in and apply the things that you're going to get in these couple videos that are coming up, you believe me, you're going to see some really crazy improvement in your trading, and you're going to see a whole lot of patience by default because of the things that you got to do to get to that point. Okay, so I'll cover on how to track the other interest rates around the countries, and that coupled with all the other things, you believe me, you're going to see it. You'll know right away, when the market's getting ready to turn. You're not going to be surprised, and you just sit on your hands and wait for it. And when it shifts, you got it. You just milk it. You just continue to milk it, milk it, milk it, milk it. Like the highs that we just came from, April and May highs that are seasonal. They happen all the time. But we knew, technically, if you understand how to follow interest rates, that was unfolding right when it was rallying up, when everybody was excited and calling for higher highs and higher highs. It was over, and then we went into a sell program on the higher time frame daily chart, and everybody was trying to catch the low, and they were getting crushed, and it moved 1,200 points. Good grief, man, 1,200 pips. So you'll get all that stuff. And I kind of more or less, I've talked myself parched. I'm really dying of thirst. And I hope you got something out of this basically tonight. And I really appreciate your patience with this application. I know sometimes, the audio may go out on you. But no, I'm not king. I'm not king. I meant that as a joke. Unfortunately, I can't record it. It wasn't recorded, but a lot of this stuff you'll see in the videos coming up. And again, these are things we continuously do in the Pro Traders Club, and I'm going to try to do the Pro Traders Club as a pre-market analysis, like we were planning on doing in February of this year. But I'm not going to try. I'm not trying to draw any more attention to it than that. Let's just leave it there. Let's not talk about it on the thread. Let's not post about it. Let's just let it occur. Okay, just wait, let it happen. That's why we're not talking about it. You're very, very welcome. And like I said, I hope you guys gleaned something from this that was useful. And I wish you good luck and good trading.